Welcome back to the Bitcoin Layer. I'm Nik Bhatia. Today, we have a special repo update for you, as well as a fantastic interview with one of our favorite guests, Matt Dines. But first, I want to talk about repo because it's the center of our attention. We're going to throw up this chart of the SOFR to IORB spread. This is the rate, the difference between the Treasury repo rate in the market and what the Fed is offering banks on their reserve balances completely risk-free. This is an indication, this spread itself, of tightness in the reserve market. And we do believe now that the Fed is going to end quantitative tightening and introduce at least a plan for the expansion of its reserves. JP Morgan just wrote a report that echoes what we said last week, which is that reserves should be targeted by the Fed to expand at the pace of GDP. They will probably be doing it in bills, and they will make a big deal to not call it QE or to tell you that it's not QE. It is not going to hit duration, but it is going to be an expansion of the balance sheet. So Dines and I will talk about that today. But so that you see this chart, which came off of 14 basis points down to 1 basis point as of our last update, it's now back out to 6 basis points. That means SOFR at 4.21 is only 4 basis points lower than the Fed's intended interest rate window. We call it a corridor, and we call that 4.25 level a ceiling. So these are the important numbers that we are watching. We are looking for the Fed to make an announcement on QT and on its balance sheet right away because they don't want a repeat of a big time repo crisis. And with that repo update, Matt Dines, welcome back to the show.
I'm just going to hop in there. Yep, repo has become, I'd say, tight, similar to where we were in 2019. Now, it hasn't quite gotten that bad. Just compare and contrast, though, we're back at that point in the money market, interest rate cycle, where front end rates want to come in and complete that normalization of the yield curve from short rates overnight all the way out to the 30s. I'll talk about that. We are at a different point in stability, though, from the United States domestic financial system establishing itself. And what I mean there, the transition that's been underway, 2010s were about deprecating LIBOR, moving the kind of overnight spot liquidity funding, the most elastic supply of liquidity in the global dollar credit system, away from an offshore, just purely printed, unsecured standard based on no market interest rates, to SOFR, where it's centrally cleared repo, everything's secured by U.S. Treasury debt. The United States itself, and by degree, its own primary GSIBs have more control over dollar short-term rates. I want to get that across to people. What happened in 2019, and the shock that came in with COVID, and the repo crisis kind of presaged that. We're at a different point in terms of stability. So I don't expect as my base case for the train to, be as rickety and fall off the rails. This is where, in the interest rate cycle, I'll talk about that in a second. This is where the pressure builds, but it doesn't necessarily mean that we're dealing with, inherent collapse, right? So we should be more robust, like from New York, Washington, D.C., all the other regional Fed branches to address, this repo market volatility, right? Now, big picture, what's actually happening in interest rate markets right now? So we're at that point in the interest rate cycle, and this will get into the business cycle. I'm going to foot to a textbook that's, a lot of the best information is old, and you have to go dig for it and listen to the right people. And Nik, you're great at this. Russell Napier as well, with Library of Mistakes. He'll point you in the right direction. Read a history book, foot that to what's happening at the present situation. But author named Gordon Pepper, professor, I forget which UK school he was, but he comes from the City of London banks, worked in Hong Kong, etc. He's a professor, like you, Nick. He goes out, teaches, what he learned to the students to hopefully make sure we learn from, prior generations' learnings and in financial markets, and also avoid mistakes. Never works out that way. We'll always trip over our feet. The book is called Money, Credit, and Asset Prices. It's a it's an asset pricing theory based on, monetary dynamics. You're talking about at the Bitcoin layer. And so, basically the structure of what's happening in interest rates, it's basically savers and investors responding to incentives based on the supply and demand for credit money. And, in terms of just putting us into the cycle where we're at right now, when short-term interest rates start to fall as they have been doing, what that's actually saying is there's more supply of money in the system looking to deploy itself into, let's say, start with bank deposits, but the bank then looks to deploy into loans. So you've got savings looking to deploy into credit. And then you've also got to have the other side of that. It takes two to tango. You need borrower demand. And this is where, once you cross over that hump, interest rates peak and they start to decline, or the opposite of that, bond prices trough and start to rise. What's happening is the savers, the private investors, who they build up a lifestyle based on interest income, or it could be portfolio income. If dividends will correlate to this on risk asset earnings. But what's happening is, just recall back to 2023 when everybody got used to 5.5% yields on money market, right? They built up a consumption pattern, or if a business, it could have been an investment, based on low duration risk, no credit risk, earning 5 to 5.5. Now, what happens when borrowed demand starts to become saturated? Yields start to come in. Now, as part of that process, private investors do not like the resulting reduction in their income, and so what they'll do is they'll extend further out, and the yield curve will both kind of renormalize from the inversion, and it'll work itself out from different segments of the curve. But that's exactly what we've seen from 2023 to 2025. We've started to see the inversion. Remember the 5s, 30s being historically inverted, 2s, 10s historically uninverted. It lasted for the longest window of time that we've seen on the modern credit-based dollar systems track record, starting in the 1960s, 1970s. But you gradually start to see those inversions come out. And then the last inversion to come out is going to be the front one in the money markets, where you're looking at like SOFR, overnight to 1 year T-bill or something like that. And then once that normalization is done, this process is kind of fully completes itself. So what's happening, private investors, what they're saying is, because of borrower demand kind of exhausting itself or saturating itself at the current yields and the current prices of the resources in the economy, so commodities, or it could be property, could be risk assets, et cetera. The inputs for the borrower to take on money, or borrow money in terms of showing up to the bank, or it could be a private credit lender at this point in terms of demand, that saturates, and you're seeing that that inversion disappear. So what's happening in that process? Private investors, they liked that nominal amount of dollar income that they become used to at 5 to 5.5% interest rates overnight, money market. And they're essentially just chasing that dragon the full way down in the cycle. They extend out. First they go, all right, I'm going to get 2 year at 4.5, 2 years now at 3.5%. Okay, well, that's what wrapping up. My income from my fixed income portfolio just declined in nominal terms. That 100 basis drop was, almost a quarter of my interest income disappeared. So now I got to go into 5s. Now I got to go into 10s. Now I got to go into 30s. And that's where you see this this bid for bonds just materializing throughout. Really, I'd say, since the bottom in Q3, Q4 of 2022, bonds have been relatively stable. inside of a box range. But it's been especially up and to the right since late 2023, late 2024. Now, it hasn't been a strong bull market because we're, underlying, I think we're in a new long-term secular bear market in bond prices. But for this outlook where we are right now, what's been happening in 2025 as the economy slows down, there's less borrower demand, interest rates want to come in. So I'll leave it there. But eventually that hits the money market where, the musical chairs just stops, or the music slows down at every portion of the curve. And then it hits the money market. And then that overnight financing, everybody has to scramble for those, those ample reserves as they become scarce. So that's what's going on. I don't, my opinion right now, or my base case, this isn't going to be as dire as it was in the repo rumble of October 2019. That could change with the facts of the matter, like the geopolitical situation, because we're in a window where the escalatory ladder has been climbed, and the big picture, multipolar conflict, that's going on as the regional powers have entered a phase of conflict, not cooperation, as we were under the post-World War II order. That regime is done. So there are wild cards that could add volatility, but base case, I would say the regulators are in a much better situation than they were in 2019 from the U.S. perspective.
So we would echo that definitely on the 2019 corollary, because the Fed was caught off guard. They didn't have the standing repo facility. There was, and they just weren't ready for that type of tightness, sudden tightness. So they have tried to learn their lesson, and that's why, I and others are projecting that next week they'll just stop any prospect of a reserve drain right here and make sure that there's a little bit of a buffer. So we'll continue to watch that. There are a few things that you brought up that I want to ask you about, and I know that you want to talk as well about Argentina and BNP Paribas, two geopolitical longstanding issues that have to do with the big picture. We're gonna get all the way there, but I want to just rehash what you said real quick about this Gordon Pepper concept. People get used to 5% yields. Then when money markets start to not give 5% yields, you have to go into another asset to get that 5%. And in that way, the savings actually gets deployed and goes into assets. Therefore, asset prices drives interest rates down and drives people out the yield curve. So and I should say out the risk spectrum, not just the yield curve, because
Correct.
this is about a whole suite of asset classes. So let me ask you, what inning of the ball game are we in terms of interest rates heading lower in this part of the cycle? I know you think it's a longer term bear market, meaning that interest rates aren't heading back down to 1 or 0, but that they'll stay around this level. So I'm just curious, do you think, and I'll just say this too, Dines, I think we're in a multi-year CapEx boom that's going to float nominal GDP and, just keep the thing rolling, as Besant has said, run it hot. We're going to talk a lot about Besant today. Where do you think we are? Yeah.
So I agree on the CapEx boom. We have to, just as the nature of where we are in the big technology, adoption, AI being a must-have or must-win, or viewed as that by the large tech representatives of every one of these kind of multipolar factions. And really, what matters for tech is U.S. Big tech stalwarts versus China's. And we're not going to risk losing that game, as you'll hear in the statements from Larry Ellis and other tech leadership in the U.S. So you have to go for it. We will know if that was well thought out or productive investment 5 to 10 years down the road. But while it's open, it's the land rush. It's it's essentially chasing, this iteration of conflicts, like version of nuclear weapons in the 1930s and 1940s. So you got to go for it. Where are we in the cycle? So start with, the liquidity cycle framework that you all do such a great job, writing about and keeping readers updated on from a day-to-day developmental perspective, and then the business cycle. So I think the key thing we know, I'm just reaching out for factoids here and trying to get the puzzle pieces to line up. One of the most important things we know is that interest rates themselves haven't bottomed yet. We know that because right now we know the Fed just starting, wave 2 of cutting for this cutting cycle. Started last September 2024, 3 cuts at 3 meetings. I think they gave 100 bips total, 50, 25, 25. Pause for 6 to 9 months. We're going to do some crazy stuff with tariffs as the new administration comes in. Let's see how that goes. Okay, it went fine, bumpy, but we weathered it. All right, now it's time for that second wave of cutting. We just started 25, and then if you look at SOFR futures, other market indicators, we have expectation that the trend on overnight funding rates is still down. That doesn't mean we know exactly where it settles out. Where is it going to bottom? 2%, 2.5%, 3%. But there's more cuts coming. And that's going to start next week. All right. So that's where we know in the cycle, which means, all right, all else equal, that those cuts in the overnight rates are going to continue to work their way out across the bond curve, which suggests to me that bond prices have not yet peaked for this cycle. Right. So there's a top in bond prices. The peak in bond prices under the money, credit, and asset prices framework, you expect bond prices, like they'll tend to reach their peak shortly after the trough of the recession, right? So what does that mean? Like interest rates will exhaust themselves at their lows as the borrower demand for money just dries up. There's just at current prices of resources, excess, labor, et cetera, for businesses to pull in the economy, they can't productively, put it to work. Now, once you get that peak in bond prices and they start to turn up, that's when you're actually in the fastest part of the growth wave. But nobody's going to see it because, literally, in business cycle, theory, the recession just ended, right? So it won't feel like that's the boom period, but that's actually where the economic boom in terms of like the fastest growth lines up. Why is that? Interest rates will be at their lowest, and what tends to happen is, as investors venture further out into risk, they'll move asset prices up, they'll move commodity prices up. Just like recall oil, 2008 textbook example, hits $120 a barrel. Put that in modern, today's real prices, it would be like much higher on the chart in terms of purchasing power. But peak WTI crude in 2008, it's that process working itself out as the resources in the economy just get priced up until it can't support anymore, and boom, it'll bottom out. And then as those resources become, ultra cheap, interest rates ultra low, that's when your private sector will start going in, and then just demand for money or demand for borrowing of credit money will trend upwards on a positive first derivative, and then the fastest second derivative acceleration that it'll have as it works its way out of the cycle. So in terms of innings, what we're working towards, we're not at the peak of bond prices yet. Just because, and the reason I say that is because we know there's more cuts coming. So until we get there, the recession is still in front of us. And that doesn't mean that a recession is 2008 or 2020. It just means some loosening up of, misallocated resources, mispriced resources in the economy. The recession, it may not even be a real recession. It may just be nominal, or it may not be nominal. It may just be real. but we have to hit that to complete out this cycle. So, are we in the bottom of the seventh, top of the eighth, somewhere in there? But I'd say in the next 6 to 12 months, this process should resolve itself. Now, in terms of gold, it's technically the same players are the marginal price setter in the gold markets as are the money markets. Now, to
Wait,
make
hold on.
sense.
I want to get to gold. I'm gonna ask you to pause on gold. We'll
Okay.
get there shortly. So I want to
Let me
understand.
just say this:
Yeah.
gold and bond prices will share a tendency to peak in near proximity to each other. So this gold wave, we've seen the highly volatile pullback this week. If bond prices successfully correlate with a peak in close proximity of gold at the top of a wave, that would suggest that the gold price, the peak of this cycle, the markup is also still in front of us.
Because interest rates are still headed lower.
Yes. And it's the
Okay.
same players. Like gold is a central bank driven market at this point.
So we'll get into the same players concept, I promise. Now, are you saying that the recession will happen you're saying the recession happens once the market tells us that the demand for credit is exhausted even at low interest rates? That's what you're saying, generally speaking, Dines?
Yes. Yes. And you'll see the like other signals you'd be looking for, bad underwriting in the origination boom, starting to crack and fail. And we're also seeing that, especially in private credit or bank lending space. Not so much in the public bond markets, but in the cuspiest lending, you're already seeing that. First Brands, Tricolor, etc.
So you're saying that we're actually closer, meaning in the later innings of this current economic cycle, heading into a contraction, whether it's nominal, real, at the margin. And then once interest rates fall to their lowest point, which could be soon, maybe what on tens, I'm curious your thought where that is, that at that point, we will resume or engage in a multi-year capex boom. I want to make sure that I'm understanding how you're seeing this economy play out, because one of the things that I have been saying is that yes, rates are going down, the economy is slowing at the margin, but I don't think we're going into a big recession. But maybe you can help me clarify uh, what you're thinking here.
Yeah, it doesn't have to be a massive recession, just has to be a bottom, right? Free up the slack. And then what you want to get to is a reflation after you bottom out. So you need to enable the conditions for a reflation. What is a reflation? It is basically a balance sheet expansion, more credit creation, more originations into your domestic economy. That credit creation will, in a part, fund this capex boom that has to happen. It'll also fund some consumer, mortgages, all of that. And then it also has to enable the U.S. Treasury debt to service itself. So to fund the debt obligations that we're signing up for, the Treasury expansion, the public debt expansion, that has to happen. One big beautiful bill locked that in, but it was going to happen, like it had to happen anyway. You need to create this credit expansion, this reflation, to make that own debt solvent, right? And this is just it's honestly a capital war. You've done a good job, communicating that narrative and educating on that narrative with Michael Howe every guest episode. I listen to them, but like that's what's going on. So every regional power block and my framework of what's going on in history, like thinking back, this is 500 years, evolving. You need to keep your credit stack solvent, right? If you can keep financing yourself, your economy, And as you're at war, or as these resources come into conflict, who's going to have access to them? Which economy, which financial system is going to have access to essentially this base layer collateral that the whole economy built itself off of? If your credit stack is solvent, that's a competitive edge. And I've come to the conclusion, you win these wars based on like two or three things. It's financial system solvency, ability to raise capital to keep going, and then it's ports and trade and a navy. Those are the three things that matter. If you have those, you win. Standing armies, all of that. You talk about PLA having largest armies, irrelevant unless you can get them on the ground, which is hard to do. So I went down a little rabbit hole there.
Yeah, I
Maybe
didn't expect you
questions
to
bring us
go
back.
right to the shot at the People's Liberation Army, but here we are. It's important to note what navies do across history when we think about the Dutch Anglo Wars of the 16th century and the subsequent British Empire, and it's the reliance on its navy to enforce those ports, those trade routes. We also think about what's happening with U.S. alliances in Japan, Australia strengthening, and also the U.S. positioning itself more based in a Western Hemisphere. Um, in terms of thinking about South America a lot more. Uh, we'll get to Argentina shortly. Before we get there, though, I want to ask you about Besant and the debt to GDP, the deficit to GDP as well. He's trying to hammer the table now that getting it from a six handle to a five handle is a big deal. It's supporting interest rates falling. It is a sign of extreme optimism about the US economy coming back from the brink. So we're going to have a chart on the screen here that's debt to GDP. This is not deficit to GDP here. We are going to be talking about deficit to GDP, but the debt to GDP itself has flatlined and even marginally declined over the last 5-year period. GDP is rising nominally 6+% a year. The deficit is also the deficit itself is around 6% a year. So if that ratio is 100, that basically means that the debt itself is expanding at 6%, which it is around there. So I want to ask you about Besant. And I should say, too, that in our last episode together, Dines laid out beautifully why U.S. housing and essentially a refi, HELOC, and new home origination wave is essential to uh, the U.S. dollar system, onshore dollar system itself. Uh, the first order is expanding, but the second order is that persistence and that healthy capital structure, that well collateralized capital structure. So people should go check that out, because that was a lot of a Besant uh, focus in terms of who might be the person executing that strategy itself. But talk about the debt to GDP, the deficit to GDP, the Besant Trump agenda, what's going on, and how this impacts your thesis on the US economy, the CapEx boom. Because if the agenda wasn't successful, then continuation of some of the things that you have in mind, it wouldn't be possible. So that's the setup. I'm curious your thoughts.
Yeah. So that reflation you talked about, housing market driven, could be some real estate, data center projects as well, driving that. If you can't finance that, like you can't achieve that reflation, and then your financial system, is essentially incapable of competing in this era of competition, right? So it's a necessary, it's a necessary and sufficient, condition, to enable that reflation to take place. Once this, process we talked about in the interest rate cycle and business cycle, works itself out, that's the step after the next step. What happens once we close the ninth inning out, walk off Dodgers home run, World Series is won, all of that, interest rate bottom is in, to make an analogy, that's when the reflation needs to start happening. American consumers, late millennials, Gen Z, who couldn't afford houses, for the last 10, 15 years. The access to credit needs to be there. The borrowing rates need to be there. The jobs need to be there. And the price of the housing stock itself needs to be affordable. All those things need to work out. Now, the other thing too, on the CapEx side, data centers, everything else, penciling out, the financing, you need to free up like capacity in the dollar system to fund those things as well. And you see in the headlines the last 6 months or so, the same way you get the equity financing scheme that's been leaned into as a tool, like MP materials for rare earths, Intel for chips. We haven't quite gotten to peak usage of that tool for the AI CapEx boom from Treasury or Department of Defense participation in the data center build out. For now, it's really leaning towards the private credit lenders. So, for example, Meta had a big deal they announced with PIMCO as their kind of capital provider of choice to fund their own data center build out. But you've seen the other usage, kind of the circular equitization scheme usage that you'll see on social media. Everybody sees it's happening, but OpenAI buys shares from AMD. We'll trade shares for GPUs. We'll mark up the shares. Magically, the shares, the market cap pays for itself. That scheme has been utilized as well, like non-cash financing for to fund this build out. That can work. Like that black magic can work and deliver results. Like so long as the money market and liquidity kind of backdrop is favorable to that risk asset price bid. But the closer we get into that process we described, at the beginning of the podcast of the interest rate cycle, that trough in interest rates being in front of us, that's demand for borrowing, declining, excess capacity of money from savings perspective. Your AI, system or build out is kind of riding on that same money market wave, which lowers, like suppresses or pulls back liquidity and risk assets eventually. So you have to kind of resuscitate that whole thing. Ideally, here you'd have credit financing in ample availability to fund this data center build out from the kind of strategic perspective of winning this AI arms race.
All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archlending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Now, Dines, you mentioned TBL liquidity and the things that we track that are moving the system. Now, if I'm thinking through the lens of TBL liquidity, and you're telling me we're coming into soon a ninth inning where rates will be down, but this will cause some sort of contraction, or there will be less borrowing before there's more. And if there's less borrowing, banking assets should be in decline in that environment. I know that there's a whole private credit angle to this that we don't necessarily have to get to right now. But if I'm thinking about risk asset prices going down, in this sort of last part of the game, even if it's not a crash but down, that would mean from our perspective that something would have to push TBL liquidity lower. It won't be lower rates because that raises TBL liquidity. Could be a higher dollar, but it could be lower banking assets. So we're going to show viewers this chart of banking assets within our own liquidity indicator. This is what we're using to track. This is looking at global banking assets, major central banks and commercial banks as well in the United States, uh, which are a very important part of the system. Is this indicator or is this time series rolling over, Dines? And in your late inning scenario, would this number be heading lower in your mind? I know you track actually the commercial banking assets
Mm-hmm.
side of the balance sheet on a weekly basis from the Fed, the H8, if I
H8.
remember.
Yep.
Yeah, yeah. So tell me what you think about this.
Yep. So the most interesting thing from the H8 perspective, I'll just stick to the domestic US dollar system first and then talk about rest of world. In the US banking system, yeah, we have seen a slowdown. There is a little bit of a turn happening in, we talked about the balance sheet expansion, the reflation that we need to see. Doesn't need to happen immediately. We're going to get through this little 6 month, 3 month, whatever that window is, the tightness in the front end. Let the curve normalization happen. We'll find the bottom. And after that, we need to enable the reflation, which is that liquidity, that balance sheet expansion. The US system, we're at the point where, with banks, you see it in their cash assets on the H8 report. It's in contraction, which means there is not just a race for cash, but there's a reason they're cash is becoming scarce. It's that the musical chairs are that game. The music is slowing down, potentially stopping, all of that, and it's the chairs are being pulled away. So that's the situation. The U.S. Domestic financial system is. They're still maintaining a degree of credit creation, expansion. Like that hasn't choked off and pulled back. It's slowed down to a trickle in a lot of different line items, like say real estate lending, like slow. We talked about everything going on with agency, reformation, exiting conservatorship, all of that. That's down the road. That game will come at a later date. For now, the credit expansion in the U.S. banking system is focused on lending to the other line item, which is non-bank lenders, your private credits, business development companies, et cetera. That's expanding at about a 3% annualized rate, 2 to 3% for the last 6 months. So the U.S. banking system is right now primarily concerned with making sure that this second layer of essentially credit origination that the U.S. financial system didn't want to do in this broader environment at 10 to 1 leverage, right? For every $10 in assets, $1 in equity. The banks, collectively made this decision to work with, private financing arm, the private credit industry, so that the bank could underwrite into business risk or commercial lending at 2 to 1 lending. So their equity now is protected, tightness at 10 to 1, it's 2 to 1. So they have much more cushion and remain the senior lender, which means if there are credit losses, in the middle market commercial lending at 10 to 1, if your credit experience losses of, even like 5-10%, right? The capital you held against that loan to originate it, depending on, whatever your regulator makes you hold for that specific loan, could be 6%, 8%, 10%, something like that. A 5 to 10% loss at 10 to 1 leverage is a complete wipeout of capital, versus at 2 to 1, you've got 50% cushion. You can, as the bank, you can actually weather the losses, and it'll end up being the private equity or the private credit originator who is taking the first loss. So That's how the U.S. system has kind of designed itself in the last, say, 10 to 15 years. It's another kind of preparation. It's another arm of defense, like same way we rolled out SOFR. Like we're prepared for this era as much as everybody thinks like the rest of the world is just running over the U.S. Our debt situation is the worst. It's all relative, right? So from the U.S. perspective, this like if it is a liquidity contraction, it would come in the it would I expect it to materialize out of a dash for dollars. But that's where Nick, you mentioned, the setup of the SRF, the standing repo facility, those integrations. Behind the scenes, they've had, since the banking mini crisis of spring of 2023, they've had another 2.5 years to prepare for this. So as we go into this war, we'll like now the rest of us, the public who don't see, what the Fed, the regulators, the lender of last resort, the setup architecture looks like. This is where, we'll finally see. We'll get mark to market. Now, you show in your assets chart 75 trillion in dollar assets in the global banking system. About the US on the H8 report, it's 24, 25 trillion. So domestic US dollars should be about 25 of that. And then I assume the other 50 trillion, you're kind of just marking to market and converting back to dollars to get to that 75 trillion. So US banking would be roughly a third of the global capital if you just convert it into the dollar measuring stick. The pullback, like if you get instead of the reflation, which is what we ultimately want to get to, right? If we move the wrong direction, for a week, a month, a quarter, etc., depends on how much degree, right? Is it a big kind of contraction like 2008 or 2020? I don't expect it as the base case, or is it, some pressure, and then we alleviate that problem, fix it structurally, if you will, or address it structurally. Nothing's ever fixed per se. There's always going to be implications and trade-offs of whatever policy decision is made. But then once that situation is resolved, we reflate off of that. I think what we're seeing, I described the U.S. Domestic financial system. I assume, there's not, going to be an imminent collapse, not 2020. This isn't going to be COVID again, barring, like an external exogenous geopolitical event, war, etc., something like that. I think that liquidity contraction, I would be watching the other kind of regional dollar liquidity kind of pockets within the global dollar architecture, and there's two of them that really matter. There's Europe and like continental Europe and London, and Southeast Asia. So what you actually want to have, you talked about the dollar directionally, to get out of that contractionary effect in terms of balance sheet, top line capacity, and get back into reflationary mode. You want your currency to weaken versus the dollar. Start with Japan because they're like a much easier case. They're on much friendlier terms with the U.S. if you read behind the headlines. The new PM, Takaichi, not 100% clear on the pronunciation at this point. It's very early. We don't know her yet from a foreign standpoint. I feel like we were just getting used to Ueda, and we barely knew you. But Takaichi she's friendly to the White House administration. Trump tweets, he's like, "This is great," etc. Yen is back into weakening versus the dollar. They're on good terms with the U.S. We like this. I don't expect the dollar liquidity problem to come from the U.S. and Southeast Asia, but that could change on a dime if China decides to become aggressive in, say, the South China Sea, for example, where we've seen, over the course of a decade, the escalations have gone like only one way in terms of conflict with the Philippines, harassing, building out these mini military bases across little shoal islands, etc. So that could happen. That would be kind of adverse to this reflationary process accomplishing itself. I'd say the other one or it's more likely to come from, would be Europe, in terms of, the FX markets. The weakening of the dollar that we've seen in 2025, and this is policy, like Treasury's on board with this, Federal Reserve, FOMC is on board with this, the US GSIBs have to be on board with this. Uh, they're moving towards a weak dollar policy, and the primary driver of that is your London and Europe currency. So Europe and British pound are not weakening against the dollar, which in this environment hurts your exports, all of the above, everything that implies. So I think from the geopolitical standpoint, who is, cooperating and in the good graces of kind of following the U.S. led factions, like horse, like who's out in leadership. It's really the UK and Europe who I would watch, in my opinion, as the hotspot for this to flare up.
Okay, we'll continue to watch that. We'll look at banking assets in the US potentially roll over. And I'm just going to say something to the viewer and the listener. I'm pretty sure that most of us have not grasped this concept of the US domestic financial system moving away from a 10-to-1 leverage ratio lending into the private sector to more of a 2-to-1 by lending into private credit operators that are able to make more loans in a less regulated environment. It's one of those episodes. I only say it once in a while. You guys are going to have to go back and listen to that response a second time. It is very important. I've been sleeping on it, even though Dines has been actually teaching us about this for some time, if we go back and check the record. But I just wanted to reflect on that for a second. It's a very important concept.
Yeah.
I don't think people my takeaway is that it's more US banking system resilience, even though credit, the same amount, the same quantity of credit losses might take place in the next business cycle trough. Which I just want to get your thoughts before the next question. Is the shutdown right now, which is, we know, triggering a contraction in the economy at the margin? um, Besson has been on the tape talking about, it's X billion dollars per day or per week. Is this potentially a trigger here for something?
No,
No.
I don't think so.
Okay.
I'll get into that. I just want to make one more comment on, the private credit backdrop. I'll go dig this up in the tweets, but I want to say it was Andrew Bailey this week, but it was some,
It was
European.
Bailey in
Yeah,
Bank of England.
he
Yes.
called it like unfair that the U.S. has this setup. The private credit sector that they've kind of fostered and created is unfair in the competition. It's like, you guys could do this as well, but they don't have, they haven't fostered out the build out of private capital, right? The U.S., we've done that. We focused on building out a venture capital industry, and this goes back, into the 1950s. These things take time to build, private equity, etc. But we've spent decades investing in this, and now this becomes like a strategic asset. Private capital, who has the balance sheet capacity, they've built up the wealth to be able to, provide a secondary backstop to your domestic financial system as we enter this next phase of conflict. So your European representation, they're saying the quiet part out loud at this point. And when you don't have it, like, these things take a long time to build out. You're not going to be able to do it, on a whim. Same thing. It's the same situation the U.S. is in rare earths, right? We don't have it's really the refinement capacity that we don't have. We're not going to be able to build that out overnight. Everybody has an Achilles heel right here. Like, there's no one player who holds all the cards, all that. If we were, there'd be a unipolar world, right? It's just one player is so dominant. Every one of these players has strengths and weaknesses. The U.S., everybody thinks, I think the common perception is, private credit, it's a bubble. They're doing stupid, crazy things. And some of it is. Like, there's some There's some really poor underwriting that does take place, like, Tricolor as an example, or First Brands, where no one's really tracking the collateral, accounts receivable, backed loans, and those assets themselves are pledged, 10 times over. There is some poor underwriting for sure. The regulators haven't fully um, kind of ring fenced everything in, but all in all, it's more positive than it is a negative, and kind of my framework.
Well, I'm going to have to go back and read that Bailey article again because we actually referenced it in the last video in this similar context. But again, this is why we rely on people like Matt Dines to help us. There are too many things going on around the world geopolitically for any one single person to track. I genuinely believe that it makes the job fun, and it makes it essential to speak to people like Dine so we can get different perspectives. I want to now give you the opportunity to go back to gold. It's a very du jour topic. You talk about the same players. Now get into that idea of the same players are buying bonds as they're buying gold, central banks. Where are we in the cycle? What's driving gold? I'll just tell people, I won't name the bank. Um, I read a good report. Let's just say it was good because it had some good history in it. Gold is a historical asset and can't really be talked about like treasuries looking at the last 3 to 6 months of deficit bills and yada yada. So this bank, which I won't name, put out a report about the gold price, and the report, while it was good, most of the explanations as to why the gold price was going up were a we believe, or could it be possible that this is happening, and it ends in a question mark, then talking about central banks and the players and the overall scarcity of gold. The point being, even the street doesn't have a very good explanation to me as to why this particular rise is happening. And so I pass it to you. What are your big picture thoughts on gold, Dines? Why the
I
rally?
I think the reason you're not getting a clear and concise explanation of what's happening in gold is because, as that middle intermediary, your investment banks, bullion banks, etc., this is policy. And once the public is pulled into the trade, it doesn't have the same effect, right? So you can't necessarily just say the quiet part out loud. You'll have to have people, in the private sector helping the public put this together for them. Now, the actual messaging, we're not going to reach the same amount of people as CNBC pumping up the debasement trade starting October 1. Like, you can see it in the tweets. Like, just follow your feeds. When you read a headline, think about things like, all right, why is this person or this institution saying this? What are the incentives? Why am I hearing this now? And then think in terms of market cycles, right? When the public comes in, usually that's late phase. Like, that's when you want the distribution to take place. Versus back in 2023, gold's at $1,600 to $1,800 an ounce. No one's lining up. In the pictures, the Australia around the line, like it's the iPhone 4 being released in 2011, right? As everybody was doing. So what's actually happening here? You've got to read history to understand like what's going on with policy, because past is prologue in most cases. It's not the exact copy paste, but it'll generally rhyme and give you an indication. And to really understand this, I read a book on Christmas vacation this year, Silver, the History of Silver, by an author, an NYU professor, I think, whose name is Silber with a B. So a little bit confusing, but it gave a good backdrop of what's happening in the kind of the remonetization of silver that took place in the 20th century and got kind of short circuited, nipped in the bud in 1968, when we pulled U.S. domestic currency off of the silver standard, essentially. But what happens here? It's Treasury led. They've got quotes from FDR, quotes from Treasury Secretary Henry Morgenthau talking about how they're going to design or implement a markup to buy gold, essentially, and reflate the financial system, like the domestic banking system. And this is coming and buy gold, buy silver, right, in the 1930s. I think those same things are happening today. Like the bid is coming from central bank purchases, right? Uh, and in cooperation with that, you have to have the alignment of the sovereign, like the treasuries of the sovereign countries, and then their GSIB sponsors. So I believe there's 29 of them. I think we had 30, and then Credit Suisse got eaten. So we're down one after the latest culling episode. But you've got to have those entities aligned on this gold markup. Why is it taking place? It's part of the reflation, right? The central banks are sitting on gold assets, right? So to get that reflation, expand the balance sheet, you need your equity to expand with it. Otherwise, you're just leveraging up and creating risk. So you need to debase, the debasement trade, your foreign exchange, your sovereign FX, 3-letter acronym against gold. And you'll go into the open market as a nonprofit incentive buyer. Like you have other incentives. So you're going to mark up the gold, right? Why do you buy gold, right? Because you own it, right? It's a legacy reserve asset. Your other choices are other FX currencies or your own sovereign debt. So you could buy your debt in the market. So literally like QE, right? Problem with that is it works when you're moving rates downward in a long-term secular cycle. And, when you do those transactions, you create like there's latent demand, there's excess demand for borrowing in your private economy. That's the path we followed from like 1980 to 2020. But we wrung all of the water out of that rag, right? So we've got to do something else now. So the choice to reflate, given, all right, do I buy other FX pairs? No, they're not going to do that because they're not cooperating anymore. Like we're in an age of conflict between regional powers, not cooperation. We've squeezed all of the blood from the rock or blood from the turnip that is buying our own sovereign debt and creating credit expansion at the private layer between commercial banks as public-private entities, and then the private borrowing, mortgages, commercial loans, etc. So you got to find another way to create that balance sheet expansion to keep your system humming along and bring your equity with it. And that's where gold comes in. So this is why, like I don't think most chart watchers or the gold bulls realize the mechanics of why this is happening. They just think their thing is winning, right? And this is why, right, like you're seeing the gold longs spike the football against the Bitcoin longs. The reason gold is outperforming Bitcoin in this particular epoch, this window, 6 months, 12 months in hindsight, it may last another 3, 6, 9 months, because the central banks don't own Bitcoin. Sovereign treasuries, by and large, don't own Bitcoin, right? You've got some countries who have adopted, but they're like, if you just sort descend the stack ranks of the countries that matter economically in the world, start with U.S. at number 1 at the top of the league tables, number 2 China, number 3 I don't even know. It's so far behind number 1 and number 2 it doesn't matter. But until the U.S. and China, one of them, like the sovereign adoption works into Bitcoin, and they're incentivized again to purchase and mark up Bitcoin, you're going to see gold outperform Bitcoin in this particular window. And it's specifically because it's owned by the central banks. The treasuries are long. The GSIBs are long. They're not. They're late. They're adopting Bitcoin. Like it started the other direction, where gold was, probably 4 or 5 centuries ago, where we were on a gold and silver, coinage economy, and you started building out, bullion banks that would custody gold, and then you built a credit layer on top of it. And and the process worked its way from private sector adoption, and it worked its way down the stack, and then you end up with golden banks, and then the gold being used to finance the public sector, the governments. Bitcoin is working from that same process where gold was 400 or 500 years ago. It starts in the private and it works its way down, and that's the direction of the process. That's the direction of travel. So that's why this little window, everybody thinks very short term. Bitcoin's not performing. We've got treasury companies blowing up, all of that stuff. The reason why the liquidity is not going into Bitcoin right now, the only way this markup in gold can spill over into, like, let's say Bitcoin, you have to have balance sheets who are long both assets, and the owner could sell Bitcoin. They're on the other side of the trade to the central bank buying. Gold moves from private hands into the Fort Knox or other vaults, right? That spillover, that dollar deposit then has to go over and be reallocated into Bitcoin. Or it could be, all right, the gold is causing the balance sheet expansion itself in a long, and that owner they don't have to sell the gold. They could borrow against it in money markets, right? Or a broker dealer, if they hold it in GLD or something like that, they can borrow against it and then buy other assets like Bitcoin. But the price movement in Bitcoin is it's not the cart in front of the horse. Like, the liquidity has to spill over from that gold policy, which all of your global central banks are on right now. Essentially, they're all marking up the gold. It has to spill its way over into Bitcoin as like secondary liquidity, which is why it's kind of the tail wagging the dog at this point in 2025.
Now, let me just put you on the spot. When prices go up, what do we say on the desk? More buyers than sellers. Now, who are the buyers specifically in gold right now? Do you think this is a Besant operation? If you want to put on the tinfoil hat, do you think there are banks that are acting as agents on behalf of the US government to drive this type of thing? Do you think it's Chinese led? Who are the buyers here, Dines?
So the buy, like literally this window, U.S. is signaling, like, from a regulatory standpoint, they are trying at this little moment, days and weeks, to slow down the buying in the U.S. That's where you saw CME increase its reserve requirements for maintaining a long, gold and silver's position, or short. No one want to be short into an exponential. It's mostly going to be longs. The amount of capital they have to put behind that trade, Treasury just, or sorry, not Treasury, CFTC and CME, they just increased, that amount of capital that had to be put behind a kind of a levered position, and where most of the activity here takes place in gold and silver purchases. It's gonna start with the futures market, right? So starting with the U.S., like we know, that step to increase reserve requirements, what that does is your accounts who were most over their skis and the most leverage, highest risk, they got rinsed, or they got turned into forced sellers. They can either increase or put more capital into their account, or they can, reverse and close some positions. And that's what we started seeing, starting, 2 Fridays ago, the exact date, Friday before last. I think it was October 17th. I'll go back and reverse that. But that decision to raise margin requirements on the exchange is key. It said, hey, let's not let this thing blow off top and then collapse. Now, so the U.S. doesn't want to see this bull market stop. I think from the reasoning behind that, like if some interested party here, if you're actually the short on gold, and the answer there, who is it? It's London, right? It's European banks. They don't have the supply. Their vaults are the ones being drained. If you want to solve your problem, the best way to do it would be to force the market into a blow off top, wash out the actual capital, so that the longs, it may take them months, quarters, years potentially to rebuild and start marking policy into the direction they want it to. Take gold price in dollar terms higher, right? So if you're London, you want to get this thing going as fast as possible, right? Blow it off, and then you have years to resolve your structural short, or the excess leverage that you've created against the actual gold and silver and vault, and remake good on your fractional reserved IOU stack. So that's where I see it in the U.S. They wanted to slow down that blow off top, but they didn't. Slow down the heat, or the pressure in the gold price, but they did not want it to. I don't think they want this to stop, and that's where I get in. I don't think the gold high is in for this cycle if the U.S. wins this one. Now, if London wins this one and they force us into a blow off top, then it's done. It's going to short. Maybe it drops from here, that 4,400 high, or whatever it reached. Crash it lower. Then they cover, fill their hole, maintain solvency in their own financial system. U.S. keep marking it up, because then you can reflate, get more growth, all of that into your economy. So who wins? This is just my framework, by the way. But when I see the headlines, Muhammad El Arian come out, and you start hearing it straight from the horse's mouth, debasement trade. It's like, yeah, you're years late. The debasement started happening, for this cycle, starting from the bottom of $1,600 and change gold in Q4 of 2022. The debasement happened, same way the debasement in the 2000s, from like a gold price at $200 to $300, starting at like September 11th ish timeframe, to peaking in 2011 at $1,800 plus an ounce. The debasement is what's going on in between. But when the public starts to catch on to it, the broad public isn't following financial markets or reading page 18 of the Financial Times or Wall Street Journal every day, where the story actually is. They're going to hear it when it's just blasted right at them on page one, or on whatever midday lunch hour on CNBC, where Muhammad El Arian is out there promoting the debasement trade after the debasement has taken place. So that's where you get the public to come in late cycle into the distribution. And then you just see, like, from here, who's going to win out on the chart. Is the gold markup done? Does one of these regional powers get a break in the capital war, pick up some years to lick its wounds, rearm itself, or do we get to continue the fight? Your enemy retreated, keep going after them, which would be the U.S. perspective in this. But that's kind of how I would view this in my own framework.
Well, if anybody needed any reason to indeed watch this episode twice, Dines' response on the dynamics between the United States and London in this gold market is reason enough. Now, in as short of a time as you can, what can you tell the people to say, oh, how do you know London is short?
How do you know they're short? So the metrics aren't necessarily going to be accurate. If you have a problem, you don't want to publicize it. But how do you know the dealer's short? They extend out their delivery window. Oh, we can't deliver here. We need to move it. You also see it. You'd show up this. You talk about the backwardation in silver, right? That occurred over the last 2 to 3 weeks, a massive amount, starting at, say, 30, 40 cents developing. Then it gets up to $1, $2, et cetera. What that means, your futures contract, 2, 3, 4 months and like out into the future for delivery in a further month, instead of being upward sloping, like in a readily storable, non-depreciating, non-wasting commodity, you're incentivizing the private market to say, oh, I won't take delivery of that silver today. I'll take it next February or next March. So that futures curve action is incentivizing the private sector out of the price incentive. Like if you're silver, and silver is an industrial metal, right? the best thermal cooling, pace for GPUs, for example, like stuff like that. Um, if you're a manufacturer or you're like silver is one of your inputs, it's got all of these amazing properties that gold doesn't have from an industrial use case perspective. You're now incentivized to delay, taking physical delivery here. So the market signals themselves are suggestive. Like, hey, if you are in a pickle, it's that delivery window. You need time for the borrowers showing up at your door. You say turn them away, come back later. So you give that price incentive. But if you just put all of these, the mosaic into perspective, then you would lead you to the conclusion someone is short. And by definition, this is how a fractional reserve like has to operate. There's more claims on the thing. There's more paper asset than there is the actual collateral. When you're in one of these windows where um, risk develops because more people want to take physical delivery, they want the real thing. You start to see volatility pick up, actions like this. So it's really just reading between the lines of the headlines and putting two and two together and understanding what the incentives of each player actually is.
I could do a whole episode on this topic itself. Now, I want to get to a couple of the topics that you wanted to discuss: Argentina, BNB Paribas. Why don't you bring these two topics and then bring it all together for the viewer?
Yeah, we could do a whole episode on Argentina as well. So, all right, my framework of what's happening in markets today, I try to understand things in a historical sense where every, just like the Bitcoin blocks, every one of those kind of foots together, the hashes connect everything and the entire chain, validates from the Genesis block up to the tip of the chain, right? I try to view history in the same way. Like, understand the players, understand the civilizations, understand finance and money, so that all of those epochs or blocks in history actually make sense and the checks cash, right? So we don't have 90 minutes to add to extend the audience. This is already too long, right? But let's start with this. So the modern world we live in began in 1492 when globalization entered a new phase, right? Coming out of the kind of the collapse of the Silk Road, Marco Polo, those land-based trade routes, went through the Dark Ages. We really kicked off the modern world when Europe, led by Spain and Portugal, started sending ships to establish trade routes with the New World, the Western Hemisphere continents, and then Southeast Asia, right? And we've been developing on that historical arc, ever since. You started with a world. I'll take a Western Hemisphere focus here. It was basically entirely under the domain of Spain. This is going like back to the Treaty of Tordesillas in 1494, which probably no one knows anything about. But the entire rest of the world, non-Europe, was basically just claimed ownership but split between Portugal and Spain. Within South America itself, the only sliver of the New World that Portugal, under this agreement had domain over was Brazil. That's why to this day you see kind of Portuguese culture, economy, and to some degree some financial integration with Brazil, with Portuguese ties. Everything else in the Western Hemisphere was Spanish, right? Starting with the the buildup, kind of the disruption from the challenging startup with the Anglos out of the UK and the Dutch, the Anglo-Dutch partnership. They start to make headway into basically breaking the Spanish Portuguese, like the Habsburg Empire monopoly, and working their way into this model of international trade and financialization that we call colonialism, mercantilism, etc. We call this the transition from the kind of the Spanish Portuguese, the Habsburg Empire, onto the Anglo-Dutch Empire, which is this British Empire we're all familiar with. My point in history, this new world, this Western Hemisphere, this process, we've been working towards obtaining our own self-sovereignty, right? The U.S. as a regional power, kind of the the benefactor of the Western Hemisphere nations. I know it hasn't always felt like that. Sometimes we go to war with Mexico, et cetera. But what we're effectively doing is pushing out those pressures from both Europe, and now it's become increasingly from China, and that's where the Argentina perspective comes in. I'll get to that in a second. But basically, what we've been doing, what we've been working up to, is like reestablishing U.S. sovereignty and domain over the Western Hemisphere. Like, we don't want to be colonized anymore. Now, from the South Americans' perspective, right? You saw like big developments in history, like Bolivar just goes roughshod in the 1800s, kicks all the Spanish out. They never really got economically integrated because South America just has much more headwinds from a geographical standpoint. They don't have the same infrastructure that exists on the like just the North American geography. It just isn't as optimal. There's little pockets that are, though. Argentina is one of them, right? You got resource rich from minerals perspective. Like, there's rare earths out the wazoo there that can be developed. Same thing with agriculture. What they haven't had is the financial system and governance structure and capitalization to really thrive and achieve their ultimate potential, which is like truly massive. If you go back to the early 1900s, as Argentina was really in its peak, if you were mapping these things on a chart and doing TA, the best Argentina ever have it. Like, they were climbing the ranks in terms of like global wealth. They got up to like basically the seventh wealthiest developed market country. What happened was you had the kind of the Anglo-Dutch integration, and this is where you get Commonwealth countries, right? And common law as well. U.S. is kind of cooperative with this business group, right? And it's, from the U.S. perspective, it's been a battle between who's the senior partner and who's the junior partner in this franchise between New York and D.C. and City of London and the Crown for 250 years at this point. Thing is, with the Commonwealth, as like the Anglo-Dutch Empire is working towards establishing its global network, you look at a map of the Commonwealth countries, they never actually got any foothold in South America outside of like Guyana and a couple in the north. And Guyana is also turning into a hot button issue itself right now with oil developments, the competition with Venezuela, everything going on there. Another deep 90-minute podcast we could go into. But what you're seeing now, so what actually like short-circuited Argentina's development, like 50% of their capital base was coming in from British investment, like at the turn of the 20th century. World War I short-circuited that. Like, all of those resources had to be called, capital called, fight World War I, fight World War II. And essentially all of that growth that was being kind of laid, the stability, all of that in Argentina, they just took a massive turn backwards. They went with Perón, like an internal nationalist. They essentially isolated themselves. And from an economic growth perspective, it's been a complete disaster. It's been that thing since, I mean, in the year 2000, their Argentine peso was pegged 1-to-1 at the dollar, and now it's like 1,400-to-1. They're hyperinflating, right? What Argentina's never actually had, they've had all this potential, right? They have population. They have pretty good port infrastructure. They have a massive mega city, arable land, decent to, positively favorable climate. They're not tropical, all of that. Like, this should be a growth engine. What they've never actually had is the governance structure and the capabilities to push out that essentially foreign, I would just say, involvement or predation, like through financial system integration, government corruption, et cetera. They could never really get going. And so that's why this deal with U.S. and Argentina that was announced, it was 2 Thursdays ago at this point, is so massive on the 200 to 300 year timeline. The Anglo-Dutch kind of integration could never actually get there They tried, right? You had the Falkland Island Wars in the like early 1980s. Argentina just pushed them out. They're like, no, we don't want you, British invasion. Like, we don't want that. But you're seeing here with the movement, as their internal politics have been progressing, they've the power struggle in Argentina is basically between like the legacy kind of pseudo nationalists, the Peronists, and in modern days it's the Kirchnerists, right? They're losing. Their party's on the downswing. They're still the largest political party by seats, but Milei and what he represents, they have the coalition. They have the popular support now, not to integrate with China, who definitely wants to, pseudo colonize, integrate Argentina, its resources into the Belt and Road. Um, they've taken the deal from the US. They want US to be their partner of choice. They literally use that words in their statements that are published from the US embassy. So started, same way the US, our elections have gone, we're in this period of volatility, right? Power swings from the nationalist or populist movement with, Trump winning in 2016, swings back to the legacy kind of managerial elite class, the Bidens, the Clintons, the Bushes, et cetera, in 2020. And then the electorate like overturns that. And it's just like a power struggle. Same thing in Argentina, right? Kirchneris, presided over, the first stages of this complete breakdown from Argentina, $2,000 peg or dollar 1-to-1 exchange rate to, where it's gotten now, literal hyperinflation. The Kirchneris, the husband, the wife, and then you have, the Fernandez, et cetera. That's one faction. You've got a faction internally in a political movement that wants to integrate with the U.S. With the big picture vision. U.S. isn't going to be a colonizer. They're going to be the senior partner, Argentina the junior partner. Argentina builds itself out, completes its destiny. That's where this $20 billion recapitalization deal is so important on the geopolitical stage. Like, it can't be consummated yet until we see the election results on Sunday. The U.S. actually has to figure out how to structure it and finance this thing with minimal risk. And you'll see the headlines: JPM, Goldman Sachs, the U.S.'s most stalwart G words, figuring out how to do this deal now that Besant has gotten it done. So that it's not a merger and acquisition and a roll up. I view this as two separate partners, basically reestablishing kind of self sovereignty within the Western Hemisphere and pushing out China and Europe. Like, in the big geopolitical sense, that's what's going on. Last thing, we'll just wrap up here. I see on Bitcoin Twitter, everybody's like, "What are you doing? $20 billion going into Argentine pesos?" Just understand, in this big picture that we're in, like, this is clash of civilizations type of things. The most important thing is survive and advance into the next era and maintain your sovereignty. Bitcoin will re-enter the discussion as a geopolitical strategic weapon after certain things take place. It'll take 6, 12, 18 months. Have patience. For $20 billion, like, for there are certain things of value that you can't buy right now from the big picture's perspective. If you're Treasury Secretary Besant, that Bitcoin isn't capable of getting you right now. Integration with Argentina into your regional sphere of influence is one of them. Like, what would that $20 to $40 billion cost you in Bitcoin? It's too many Bitcoin right now. Like, it would take your stack and so much more. It's not the right time to get that thing of like major importance into your orbit. I don't want to call it possession, because I don't like that approach. I don't think our leadership, our business leaders, like, the US model that's going to be so productive in the 21st century and beyond isn't colonization. You're not subjects, you're business partners, is how I truly view this, and cooperative. And we'll mutually share defense responsibilities and capability over this new world. But you can't buy this for Bitcoin right now. That will come later. So have patience, work towards the next chapter. But what we just saw with US Argentina is a major development, like, in the 500-year time frame of this entire like globalization process. That's that we've been in since, the Columbus voyage. Last closeout here. How do we know? Right? As soon as we announce that deal, within the hour, CCP just dumps. This is like, if you're on the other end of a business negotiation, what do you do when you lose? Right? You overreact. You lash out in anger by effectively playing the card of the export controls of rare earth minerals. Like, that one cannot be pulled back. Once you've crossed that bridge, you've changed the game. You've changed your relationship with your business partners. Like, we're not within the same strategic umbrella as, like, say, a U.S. and Argentina are now, or friendly terms, U.S. and United Kingdom, etc. We weren't under the same, banner, coalition, whatever, but we were partners together. Like, ever since Nixon Kissinger unlocked the New Deal, that tape is like, that is, same way in any relationship. You can do things that fundamentally not just eliminate the trust, but there are things you can do that make it next to impossible in terms of an escalation to pull back. That's what that rare earths thing was. And because the rare earths response was, so pressing to the U.S.'s Achilles heel, like from the defense capabilities perspective, we can go rebuild that capacity in rare earths. We just need to build out the refinement capabilities, which will take years, but it can be done. We had to respond, right? But if you're the White House, you had to think about doing this in such a way. How do I respond with the right level of magnitude, but not be overly aggressive in terms of pushing this thing too hot where it gets to the point where, kinetic conflict breaks out. So you had to do something. And that's where day two, like the follow-up day, within 24 hours, you see Trump mentioning in his comments, pulling back edible oils, so cooking oils exports. This goes into China's Achilles heel, which is food supply. To build up its food supply chains and maintain food security internally for 1.4 billion people, they can't necessarily provide for their own domestic, food security needs on their own. They have to pull in imports from the rest of the world, and they have to do so at prices and unfavorable kind of economic playing conditions where they can still thrive, and their business model of manufacturing goods exports dumped on the rest of the world, and then other things they need, critical raw materials, hard metals, and then agricultural commodities, say soybeans, come into play. So you look at specifically the food outputs. 80% of the world's soybean production, this is the key staple crop. Like, soybeans basically enable your food supply chain to evolve. Like, think of soybeans as the base layer of collateral. Soybeans are an input to proteins like animal feed. You can grow, you can raise hogs, beef, etc., and kind of get yourself an actual 20th century, modern, more wealthy diet, which China has kind of graduated out of. Like, if you pull away those Jenga blocks from the bottom of the tower, it's the edible oils, and then the next one up would be soybeans. The whole thing pulls back from itself, and you're back to like a rice and porridge, gruel based diet. You can't really be a global expanding, wealthy nation if your country is eating gruel. So my point here, the food is China's Achilles heel. It really does, if you think about in hindsight, make the blocks, the hashes have to verify. It makes sense now in post why China's population growth stalled out in the 2008s, 2010s, and you had these ghost cities, right? They overbuilt architecture. They overbuilt supply of housing inventory. They now have the housing and property bust that their own credit system has to work out. Why is that? Because the economic inputs, they're reliant on essentially colonizing the new world for the agricultural outputs. To basically, keep collateralizing their own economic growth. So that's the Achilles heel. Don't know if I got into this, but yeah, 80% of the world's soybean production comes from Brazil, then the U.S., then Argentina, in that order. Brazil would be 40% on its own. US plus Argentina are, 2 plus 3 in this case adds up to number one. So Brazil and Argentina equals, um, sorry, Brazil equals US plus Argentina. Right now, with the soybean exports, um, China has strategically put pressure on the US agricultural sector, not buying a single shipment of US soybeans. They are essentially fully dependent for their food supply, their security, on basically acquiring 100% of Brazil's export product capacity. This deal you've seen in September, where you start showing orders. Look at since someone took a tweet over his phone, stuff like this. China's now bought some shipments from Argentina. What that's actually telling me, putting like reading between the lines, China, like, why would they do that when they have their BRICS partner? The B is Brazil, the C is China. They're simpatico. I think it's actually the other way around. Actually, China's now the owner in the business franchise, and Brazil's an acquired territory. Leave that one aside. They've saturated Brazil's export capacity. They're acquiring 100% of the offtake, which means to keep their Jenga tower, from crumbling, they need to go find some other soybean exports on the international markets. By definition, you can't go to US because you need to try to force a squeeze on Trump's popular support, break the farmers. So who do you go to? There's only so much capacity in town, Argentina, right? So now if you have Argentina and the US cooperating, you can kind of get kind of the OPEC of soybeans, if you will. And these two countries now can cooperate with each other, get better prices for their resource exports, and that'll play through the global financial markets, as well as the financial kind of global dollar system that we talked about, to start the process. Now, last thing, if you're Trump, you want to react, with a measured response. You don't want to have this thing blow off and escalate. So I think you're watching measured actions. We're getting to the point where something may need to happen, like a strategic soybean reserve. We have to do this very carefully, because from China's standpoint, right, like having limited access to the rare earths is one thing, and this is where the DoD and Treasury are working on building up access to those supplies. They're basically going out to market and hoarding, inventories of these key, elements on the periodic table. Food access is a whole different thing, though. Like, if you can't feed yourself, that's literally base layer of Maslow's pyramid. So I think this is where you see the statement from Trump earlier this week, little tweets that, highlight. Trump comes out and says, he's like, we do not want to destroy China. Like, that's not their intention. So, like, this is where he's actually, and when I say Trump, Bessent, White House, they're talking heads, they're going out there and being very measured and cautious on what they're doing here, because they understand how these players, when you corner someone like a wild animal into the corner, it can get aggressive. So they're playing this one very cautiously, but that's kind of the nature of where things are. And it goes to show, like, that just highlights why this U.S. Argentina thing is such a massive deal for the Western nations or Western Hemisphere, and its progress towards self-sovereignty against foreign powers and intervention that we've really been fighting for 250 years. So that's a big picture of what's going on. We covered 5 centuries of ground today, about 2 hours, but let's close it off there.
Matt Dines, from the OPEC of soybeans to the American Grand Strategy, gold, Bitcoin, the Fed, liquidity, the U.S. banking system. Truly one of the great thinkers of our time. Dines, we really appreciate you. And I can safely say that this is one of the most valuable episodes of the 3.5 years of this channel so far. Thank you so much once again. Matt Dines will include where people can find your work and online commentary in the show notes. We'll catch you guys next time.
Thanks all.